Alright guys, this is the average experience of a normal retail trader. He's like this. Wow guys, here's a mountain high. We need to short. My mentor told me to short after mountain highs. Oh, let's put this here. Let's go, let's go, let's go. I'm gonna make a lot of money. Let me just send this right here. Let's go guys, let's go, let's go. What happened? And then there's the guy who told you not to worry about it. He knows about liquidity, and that guy will be you if you watch this video till the end. Okay? He's like this. Okay, uptrend, cool. Is it low? Here's liquidity. Let's go. Let's wait for it to sweep this. Okay, cool. Now I want to see a break of structure. There we go. Break of structure. We enter right here on the closure. Right here below the order block. Boom. Cool. Where is our take profit? Above this liquidity. Why? Because I understand liquidity. Let's enter, guys. Beautiful. He won the trade, and the average guy did not win the trade. He's a loser. The other guy who knows about liquidity is a winner, and that winner will be you soon. Watch this video till the end. Now, pay close attention. Alright guys, liquidity. The reason why I'm preaching this is because it is by far the most important concept in the SMC everything. Like, you need to understand this, okay? You need to understand this because liquidity is what moves the market. Liquidity is the reason why the markets has to move. Obviously, yeah, banks, institutions, hedge funds, obviously they move the market. However, they need to go towards the liquidity and sweep the liquidity in order to go where they want to go. And me and you will take advantage of that because we know where's liquidity, where will the price actually go. All right, what is liquidity? Liquidity is like liquid cash. It is laying all over there, okay? And what is it actually? It is resting buy and sell orders. And these banks, institutions, hedge funds, the ones who actually move the market, they want to fill orders. They have millions of orders that they need to fill. How can they fill them orders? How can they be satisfied? By taking out liquidity, sweeping liquidity, liquid cash, resting buy and sell orders. They need to fill those, they need to sweep out those, and then we come in play and we move with the market. We move exactly when they move. We trying to copy them, us. I'm trying to play like the big guys, banks, institutions, hedge funds. They move the market and I will move with them. Not against them, with them, okay? And you need to do that exactly. Now, how can we actually know where's liquidity resting at? How can we know where it is? How can we know when does the sweep happen? It's actually quite simple. Think if you were a retail trader, average retail trader, where would you place your stop loss? Think. Probably, let's say you take the trade right here. You most likely will leave your stop loss below the low. Below these wicks. Now liquidity is resting above the most recent highs and the most recent lows that has not been swept yet or taken out yet, okay? For example, this right here, this is a low on a higher time frame. Remember, higher time frames always hold more power. The more higher time frame it is, the more resting sell orders here will be below this low, obviously. And let's say the price will come here, sweep it. That's when millions of orders will get filled. And it's up to the banks. Do they want to go from here to up? Or do they want to continue its direction down and take out even more liquidity? Because this is also a low. Now, first of all, for the new people out there, you don't probably know what is a high, what is a low. Now, quick reminder, quick summary. I'm just going to teach it right here, real quick, so you'll understand it. Okay, high. What is a high? High is an up candle followed by a down candle. That is a high. Right here, this is a high. Right here is high. Right here is also liquidity above it on higher time frames, okay? And what is a low? Same thing, but obviously it's not the same thing, but low. A down candle followed by an up candle. A high and a low, they both consists two candles. Up candle and down candle, that is a high. Down candle followed by an up candle, that is a low. Like this. Let me show you in drawing. high, down candle. This is the high, above it. Down candle followed by an up candle. This is the low. I hope you guys understand. If you didn't, the full teaching is on my channel, so you'll understand it better. Anyways, let's continue with liquidity. Every untouched high or low has liquidity, has liquid cash, has resting sell orders, buy orders. It has the thing that these banks and institutions want to go towards and then switch direction. So remember, we're in a higher time frame. Remember, higher time frames always hold more power. Higher time frame lows. Here's liquidity, a down candle followed by an up candle. This is a low that has not been hit yet. It has not been hit yet, has not been swept yet. There's still a lot of stop losses here. And eventually these banks and institutions, they need to fill this, okay? This is also liquidity, and this is also liquidity because these are all lows, and this is higher time frame, and they hold more power. If we go to a 4-hour time frame, the same spot, actually look, wow, look, this is a hard, this 4-hour time frame is also really high. This is a low. This has millions of orders that these banks institutions need to sweep. Now this already has been swept, and as you can see, perfect example of a liquidity sweep. Look, this is a low, has not been hit yet, like before. Okay, look, let me just go to the replay mode and show you. Like, look, this right here, a liquidity has not been hit yet. Cool. What happens then? Boom, swept, immediate reaction, and then it continues up. And look, let me just go to, obviously, look, you gotta understand this one thing, guys. We need to know where's liquidity, but when we know there's liquidity, like for example, we knew this and it got swept, we cannot just immediately enter long positions right here. Why? Because you gotta understand, sometimes they go there, but they disrespect it. The price disrespects the areas of liquidity, and then it just continues down and tries to seek more liquidity, and these building blocks, you gotta understand that. And how can we know it actually will react? You need more you gotta go to a lower time frame to see more confirmation. For example, a break of structure. Let me just go to a lower time frame right here. Let's go to a 1-hour time frame. Look, perfect example. Look, 1-hour time frame. Look, the liquidity sweep happens right here. 1-hour time frame. Look, you can literally see that sweep. What also is reaction? It immediately rejecting from the sweep. You can literally see it. It sweeps it, and immediate reaction, like rejection. That is one confluence. We see a reaction. What other confluences do we need? A break of structure. For me, like, you can literally see this 1-hour time frame. This is a break of structure. If you don't know what is a break of structure, go to my channel. I have that also. I have the things that you need, okay? This right here, a high, break of structure, a closure above the high. This is a break of structure, and here we could have entered below this order block. If you don't know what is an order block, go to my channel. This is an order block. We put the stop loss below the order block. And here is a breadfruit trade. Okay, for example, this, and we could, in this case, we could put this above this liquidity. This is also liquidity, and we put it above it. Cool, and it continued the trend. It did not react from this liquidity, and it continued the trend. Look, right, you can literally see that. And then what it did, it continued the trend, and there's the fair value gap. If you know what is a fair value gap, go to my channel. What it did, it actually continued the trend. We didn't get reaction to the downside, and went to this fair value gap, filled it, and continuation to the upside. And that's just one example. But obviously, I'm not going to talk about those other confluences like fair value gap, break of structure that much in this video. This video is based on liquidity, because I'd say that's the number one confluence, literally. And yeah, that's what happened. And look, we got the sweep right here. We had the sweep, got reaction on lower time frames, got rejection also. Rejection is really important. Like, I see some of the SMC traders who just think that when they see a sweep, they can just immediately enter. But that's not the case, because sometimes, let me just find an example. For example, this is an example. This is a liquidity. It didn't react from it. We didn't get any rejections, breaker structures, anything. It just continued. Now, some of the SMC traders probably would have shorted, but we gotta be clever. We need to see lower time frame reaction, and rejection is also really important. Same goes in any other confluence. We need to see rejection from those. Confluence, really important after the sweep. Now, let me give you an example of more sweeps, okay? Let's go on the daily time frame. For example, what do we have? Perfect example, look guys. This is also liquidity, higher time frame low. What does it include? What does it have inside? Liquid cash that these banking institutions, they need to fill. These market movers, they need to fill them. Take out liquidity. This is liquidity. This is liquidity. And also this is liquidity. All this liquidity. And voila, what happened? Look, sweep, reaction. Obviously, like I told you guys, I wouldn't enter straight from here. I would enter, we'll go to a lower time frame. Let's say 15 minutes, because that is actually a really big liquidity sweep on the higher time frames, etc. We go to a lower time frame. This is where the sweep happens. I know on the lower time frames, it doesn't look like a sweep. It just looks like it goes through it. But on the higher time frame, it's a sweep. And surprise, surprise, we get immediate reaction from it, because it goes down, it immediately starts to go up. Look, what do we have? Confirmation. Look, this right here is a break of structure. High, and then an up candle that closes above the most recent high. It's a break of structure. And what happens? That's a reaction. We also got the rejection plus the break of structure after the big liquidity sweep. Price goes up, boom. Okay, hope you guys understand that. But remember, higher time frames always hold more power. Let me give you more examples, guys. This right here, this is a lower time frame. This is 15 minutes, right? But quite perfectly, look guys, this is actually New York Stock Exchange Open, which I trade on every single day. Every single weekday I trade inside the Discord with the premium members. They make bread, I make bread, everyone makes bread. Anyways, this right here, this line is market open. What happens on market opens? Volume goes up, like really up. It goes up. And what does that mean also? When the volume goes really up, even the lower time frames will hold power. Like I told you guys, higher time frames also always holds more power. But when the volume is really up, the lower time frames will also hold more power. Obviously, I'm not talking about like 1 minute. Obviously, it depends when you're looking only for reaction on the market open. That's different. But for example, here's liquidity. This is quite obvious liquidity. Resting sell orders, like literally, like people have their stop losses here. Market opens. We got a sweep. Reaction from it too. What would I do right now? This is an example, okay? I go to a lower time frame. I want to see a break of structure. First of all, we get the sweep. We get immediate rejection. That is the first sign. Rejection is so important. If it would just go above, that's not good. We get rejection. Now I would want to see a break of structure. If you don't know what is a break of structure, go to my channel. So I'm starting to look for lows. We didn't break structure. Alright guys, we broke structure. And this is an example. Right here. Or you enter from this order block. But this is just for the video. We're talking about liquidity, but this is just an example where, like, okay, let's say 1 to 2. Okay, below this low. This is just for the video, guys. Now would you look at that? This is just because of the liquidity that got swept after the session opened. Obviously, like I told you before, I wouldn't I wouldn't enter straight from here because of the sweep. First of all, rejection. Important. Market opens, it has lots of volume. Get a sweep, rejection, break of structure on the 5 minute. Boom. And if we're really advanced, we could go to a higher time frame and we can literally see that the trend is actually bearish. That is obviously that's the first thing that I look when I look for a trade. I want to see the higher time frame trend, because that it will increase the odds. Obviously, the trend is your friend. You don't go against your trend. And this is literally, we can literally see it. The bias is bearish. But I also have a video on that one, how to spot your daily bias. But anyways, guys, that was just a quick example of how I actually trade and how I actually look for liquidities after the market has opened on 9:30 a.m. Eastern Time, New York Stock Exchange open on the S&P 500. And this is literally the exact same as the futures version. For the people who live in the United States or Canada or whatever, where the CFDs are banned, this is literally the same. This is just electric, and this is the S&P. Alright guys, so I want to talk about the trend a little bit, because like I mentioned before, trend is your friend. You don't want to go against your trend. Now, on the higher time frame, on the daily time frame, you gotta see the trend is bearish, okay? Trend is bearish. And this is quite higher time frame, so when will the trend end and when will it switch direction? We can use the liquidity as our advantage. Look, like I told you before, liquidity actually laid all here. This was all liquidity. However, it's not liquidity anymore because they are already taken. They got disrespected. They didn't switch direction. Why? Because we didn't get any reaction or rejection from them. We just went through them. And I actually showed this before, but here's also liquidity. And this actually gave us the rejection. And this is also liquidity, but we get the rejection. And like I just showed you guys before, but we get the rejection and the the break of structure right here. That's why the switch happens. Alright, so you gotta understand the trend will switch when there's a big liquidity sweep and a rejection and reaction and confirmation, such as break of structure. Okay, and that's how you know it. So yeah, me personally, I never enter straight from a liquidity sweep, like I told you before. I'm just trying to preach this to you guys, that do not enter straight after the sweep, because you literally kind of know, will it just disrespect it and go down, or will it actually go up? In this liquidity sweep, in any liquidity sweep right here, they got disrespected, but we didn't get any reaction. That's why it didn't continue and it just went down. Now, if you want to take the same trades as your trend says and not like wait for it to just go in the other direction, that's when fair value gaps, order blocks, and lower time frame liquidities come to play. And like I told you guys before, if you haven't watched those videos where I explain those, like fair value gap, order blocks, also have another video on liquidity sweeps that's like old. And literally, these stuff, you gotta understand them. And when you understand all of them, you'll be ahead of 99%. And most likely, if you master the liquidity confluence, and you know exactly how it goes, you know exactly how the trend moves, you're invincible. And at that point, you have an unlimited money glitch, and it's just based on your capital. And obviously, your psychology is really important, because you got to follow your trading plan. If your trading plan says that, you got to follow it. So you got to understand that, guys. Now, let me give you more examples. Right here, what do we have? Look, guys, examples of a really good liquidity. Look, this is actually liquidity. Why didn't it turn its direction? Like, why didn't it switch direction? First of all, banks, these market movers, they were not happy and satisfied. They're greedy as fuck. They need to sweep out more, take out more people out from the markets. This wasn't it wasn't enough for them. Okay, no rejection, no break of structure, no reaction, no confirmation. Okay, we continue down. Boom. What also do we have? We have this area of liquidity. Okay, we didn't get there. It creates this sort of, look, it creates this area of liquidity. After that, this has a lot of liquidity because there's a lot of equal lows and relatively higher time frame, guys. So look, all of these get swept. They get swept. Banks are happy because rejection, break of structure immediately, and continuation, switch of trend. That's what I'm talking about. Liquidity sweep isn't enough. You need the rejection, break of structure confirmation, all these things. And if we go to a lower time frame, if you want to catch the perfect trade, in this case, we would go to a lower time frame. This is actually quite perfectly, I mean, you literally see the volatility change. Why? Because sweep, and this is quite frankly perfectly with when the market opens, actually. New York Stock Exchange opens. So this is 9:30 a.m. I know it seems it's different, but market opened right here, 9:30 a.m. It says 16:30, but it's 9:30 a.m. Eastern time. The sweep happens. Market opens. There's lots of volume. Rejection, break of structure, high closure above the most recent high. That's a break of structure. Boom, you could enter from here. Below this order block. Where's the order block? Right here. And I would personally, like if this would be right now, if this would be me right now, I would put it above this higher time, like this has a lot of liquidity. So just to increase the odds, I'm gonna go there and voila, that's perfect. I know this is kind of long-term trade because this is all the way up Friday and this is Thursday, but still. And as you can see, it didn't actually react from this, but it didn't give us reaction from this liquidity. It just went up. And most likely what happened here was news, because this is actually when most of the news happens, which this is New York session open right here, 15. Obviously normally it's 8 a.m. Eastern time, and the news usually happen 30 minutes after it, higher time frame news, and we can literally see that the news happened. And we took out liquidity, no rejection, no respect whatsoever, and no break of structure. Trend continues. Alright guys, this is a quick summary for the end. So liquidity, where is it, where can we spot it, how can we spot it, and let's go. So above the higher time frame highs, like I showed you before, and also below the higher time frame lows, like I told you guys. And the reason why I'm saying higher time frame, because you gotta understand, higher time frames always hold more power. Like for example, a daily time frame liquidity sweep is much more powerful than a 30-minute liquidity sweep. You gotta understand. And after you see the liquidity sweep, do not immediately enter. You have to go to a lower time frame to see rejection and a confirmation. What is a rejection? It actually reacts from it. Like let's say there's the liquidity, there's the price. It goes there and it immediately starts to go to the other direction. That's how you know it works. And then inside the lower time frame, you see the break of structure. And if you don't know what is a break of structure, don't worry, I got you on my channel, like I told you before. Anyways, and let's say we're in a trend, we're going up, for example. You gotta understand. Let me just show you on the charts. Right there. If you guys know something about a trend, how the trend moves, for example, uptrend, higher highs, higher lows, it moves like this, always has to move like this. You have to understand, it moves like this. It never really actually moves immediately up or down in a downtrend unless there's news, but the price tends to fix itself because there's fair value gaps and also lower time frame liquidities. For example, this one, this is for example a trend, there's a lower time frame liquidity. When we take it and see rejection and a break of structure, then we can continue and there we can enter. I hope you understand. That's like a trend. And guys, that's when the lower time frame highs and lows come into play, where we can seek liquidity. But most of the time also fair value gaps and order blocks in a trend is really important. Okay, really important. But the higher time frame highs and lows, it's like when we're about to switch the bias. Like there's liquidity, the trend is bullish, but there's the higher time frame liquidity. It sweeps them. We see the rejection, break of structures, everything, and then it switched the complete trend and bias. That's good. And remember, we only enter from the liquidity sweep after the rejection and confirmation, because most of the traders that I see online do not fucking talk about this. They only say liquidity, 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 let's make money, but they never talk about the how the fuck can you enter from it. They just talk about, yeah, liquidity, let's go, but they never talk about the rejection and the important things that you need to see after that. Because if you do not realize that, you will get eaten alive. Because as I showed you guys before, there's liquidity, but they just get disrespected. You see the rejection and the breaker structures, everything, and then it switches actually the direction. You understand that? And that's it, bro. Join the free Discord from bio. Take your trading to the next level, and I'll see you on the other side. Peace out.